You're not overpaying in taxes because you're careless. You're overpaying because nobody taught you the game. Hey, I'm Neil, founder and chief tax strategist here at Tax Sherpa. And what I'm going to be doing throughout this video is helping solopreneurs understand how people overpay, why people overpay, and then start up how to fix it. Because I don't know about you, but for me, I would rather you take all the money you pay in taxes instead of sending it to the government. I'd rather you go to Vegas, put it all in black, and lose than send that same money to the government. And the reason why is because the the money you send in taxes, the money I send in taxes to the government is actually making the world a worse place. So if that resonates with you, keep watching. If that scares you, scroll and keep moving to the next thing. So, for those of you who are still around, welcome. I'm going to show you the biggest mistakes people make when it comes to their taxes, how they make them, and how to fix them. So we're going to go through seven biggest mistakes that cost solopreneurs thousands of dollars every year. So here's the thing. Solopreneurs basically get screwed when it comes to taxes. And there's a reason why that is. It has to do with how the tax industry is structured. So on the low end of the spectrum, you have people that work for, let's call them discount shops. And they specialize in the volume business. So they want to churn through as many 1040s as they can each year. Typically they're seasonal, and then they'll just plug in your numbers, say, here's your tax return, and go on about your way. On the other end of the spectrum, there are firms that specialize in large corporate and high net worth individuals, and they can charge. I've seen one invoice for $135,000 for a single tax return. Not even anything else, just the tax return itself, which is good work if you can get it. The people in the middle that aren't just a simple W-2 earner and aren't a high net worth individual, by default, they are stuck going to those less prepared type preparers. And that's simply because of economics, right? You can't afford $135,000 for a tax return. They end up getting bad service. And for me, I've been a small business guy my whole life. I got into the tax world because I had my own small business tax problems. And in solving those, back when I owed the IRS $1.3 million, in solving that, I got into the tax world and was really educated in the field under a former Wall Street tax attorney. So I am a small business guy. I have been one my entire life. And so I'm here to help you manage your life better and get part of it back from the government. Because being a solopreneur is hard, right? The average solopreneur is working from January 1st through April just to earn enough to pay taxes. Because if you go out and you do whatever it is that you do, and you bring in money from a customer and you pay whatever your expenses are, and then you take the remainder and that money goes off to the government, as far as I'm concerned, you worked for free that day and you worked for the government instead. So that's a third of your life. And this video is going to be your roadmap to winning that time back. So on average, I tend to save people about 73 days of their life every year in terms of money that they were sending off to the government, and now they have that for themselves to reinvest in their business, to reinvest in their family, to reinvest in their community, or just to go to Vegas and put it all on black. So this is going to be part one of a larger series on tax mastery for solopreneurs. If you want more videos like this, subscribe and check the rest of my channel, and you'll see lots more. All right. So people think that the tax problem is the payments that they're making, the quarterly payments, the refunds, the forms they fill out, and receipts they keep. But that's really just the surface of the issue. It's just the tip of the iceberg. So what's below the waterline is really what drives the whole situation. So we have entity structure, we have payroll setup, we have bookkeeping systems, we have timing strategies, we have estimated tax planning, we have retirement vehicles, fringe benefits, document systems, cash flow categorization, personal versus business separation, and dozens of other micro levers that no one ever explains. So the IRS does not reward your effort. It rewards structure. So if you take a look at the U.S. Master Tax Guide, here's one. This one is from a couple of years ago. It's 2023. But if you look here, these pages right here are the tables. So that's the tables of tax rate. And what that does is it lists out filing status, adjusted gross income, taxable income, and how much tax you pay based on that amount. And there's a few dozen pages of that. The rest of this book, all this part, is what applies to who, when, and how, and what are the exceptions to all those things. It's not about how hard you work. It's not about how good you are at what you do. The IRS is about their rules, and either you follow them, and by following them, what that means is doing the things that Congress wants you to do, or not. Okay? So all of tax law is just a series of carrots and sticks. So the carrot is pay less if you do the things we want you to. And what we want you to do is actually to improve the economy. The US government knows that it cannot produce anything. And so it incentivizes small business, primarily, small business to create the things in the economy, whether it be housing or new industries or whatever, to improve the standard of living for all Americans, to increase economic activity, and so on. The stick is if you do things that Congress doesn't like, then they tax you. And that's it. All right. So, if you can work your tail off, but if you're in the wrong setup, you're guaranteeing to lose, because that drag of money you spend in taxes is money that you could have spent on doing better in your business. And by sending that away, you're not only is it painful, but also it is preventing you from reinvesting that into growth. I spend a lot of time talking to crypto investors, and there's this concept of FUD, fear, uncertainty, and doubt. And really that summarizes the whole thing, right? Fear is huge when it comes to the IRS. People fear the IRS itself. They fear getting letters. They fear looking stupid. They fear making mistakes. They fear not knowing what to do. And I understand this fear entirely because I had it myself. So back in 2007, I started getting letters from the IRS saying I owed them the $1.3 million I mentioned before. Now, I knew right away that this could not be right, but I didn't know what to do. I didn't know who to call. And so I just put it in the corner and tried to forget about it. And then a month later, another letter comes. And a month later, another letter comes. And I'll tell you a secret. If the number's big enough, here's what happens. You get a bunch of letters, you ignore those, then you get certified mail. And you get a bunch of those. If you ignore those, then you start getting phone calls from revenue agents. Mine was named Joyce. And I spoke to her one time. I told her this was a mistake, and she was like, blah, blah, blah. We don't care. And then if they go through all that process and they can't get satisfaction from you, which they can't from most people, then they'll start going after whatever it is that they can go after. In my case, I was flat broke at the time. And so the only thing they could get after was my paycheck. They just garnished my wages. And my employer, by law, had to cooperate. So I understand the fear, but that doesn't actually help. The uncertainty really comes in that there's all this conflicting advice out there. You go on YouTube or you Google something or you see something on TikTok. There's all kinds of different things. Some of them are outright tax fraud. So you got to be real careful. Every tax pro gives their own answer. They're all different. And the laws change every year. Not only do we have major legislation changes like we just had this year with the One Big Beautiful Bill Act, but also built into each piece of legislation are annual updates. And so the rules change a little bit every year, even if there is no tax law overhaul. So, you end up feeling where the rules feel like they're shifting under your feet. And then the doubt, feeling left behind, feeling embarrassed, feeling, oh, that guy over there gets it because he has a nice watch and drives a nice car. Fear of being judged. So I can tell you from experience of working with thousands of small business people, 80% of small business owners are completely disorganized. 20% have their stuff together and they make my life easier. But really, you're in the majority, the vast majority, if you feel like you are disorganized. And as a solopreneur, you're probably great at what you do. And that's how most solopreneurs get into business, is that they're great at being a plumber, or they're great at being a consultant, or whatever it is. And then they go through whatever learning process they have, usually under somebody else or some larger company, and then they go off on their own. And this gets into what Michael Gerber called the E-myth. He wrote a whole series of books on it. And the E-myth is the entrepreneurial myth. And the myth is that because I'm good at doing a thing means I'm going to be good at running a business doing that thing. The service or good you're providing is completely different, a different set of skills, different set of everything, than managing a business that does that thing. So most founders are technicians, not trained as CEOs. You didn't go to business school. The people who do go to business school end up working for corporate America. And so both business school itself doesn't teach this, and the people who are in small business don't learn that there is such a thing as small business tax strategy. So, all of that stuff is below the water. And what we want to do here is we're going to start pulling the iceberg up out of the water so we can see everything. And so the first hidden problem that is costing solopreneurs the most money is mistake number one, running everything as a sole proprietorship. So sole proprietorship on a tax basis is just you, right? So you're going to file what's called Schedule C as part of your 1040 tax return. Now, maybe you have an LLC, maybe you don't. But either way, if you're filing a Schedule C, what you're saying is that this business operation is me. It might have a different name. It might even have a different tax ID number. But for tax purposes, it is just me. Okay. There's a few problems with filing Schedule Cs and the reason why they are a wealth killer. So number one is that they have the highest audit risk. And there's two different reasons for this. They're intertwined. But reason number one is that the IRS does a report every few years called the tax gap. And what they mean is they say, okay, we've had this year that has been filed and we received this much in tax revenue. And then we had our audit cycle. So audit cycles typically go 2 to 3 years behind. So in 2025, they're auditing 2021, 2022. But that cycle closes and then they have an analysis, right? So they say, okay, we had this much was paid, this much extra from our audits we figured we actually collected. And based on our audits which is basically a sampling process, we think that this much more should have been paid by Americans in terms of federal taxes. And there's the different flavors of federal tax, but that is where they come up with this tax gap, the gap between what they think they should have been paid and what Americans actually paid after being audited. When they do that analysis, they come up with a report and they show the categories of the gap. And the largest single category for the tax gap analysis is personal tax returns business income, which is your Schedule Cs. Okay? A Schedule C is the highest risk thing you can do on a tax return just because 30% of the missing money that the IRS thinks is out there comes from that category. Okay? So highest audit risk. Number two is that a Schedule C, by the nature of it, is just you. All the net earnings from the Schedule C are subject to what's called self-employment tax. That is the personal version of the payroll tax where you're paying in for Social Security and Medicare. So it amounts to 15.3%. There are limits on that. For simplicity here, we'll just talk about the 15.3%. So 15.3% on every dollar of profit. Another problem with Schedule Cs is that there's no structural protection from a tax basis. Now, an LLC might save you in a lawsuit, maybe not, depending on how you're operating things. But from a tax perspective, the Schedule C business is you, okay? As opposed to if the LLC were to file a separate type of tax return, now it's a separate entity and it has its own issues. Now, maybe you as the owner still have an involvement. It's a more complicated question at the very least. Another issue with Schedule Cs is there's no optimization lever. So there's a lot of things you can't do as a Schedule C that you can do in other entities. And fundamentally, I sympathize a little bit with the IRS when it comes to auditing Schedule Cs, simply because I have seen people bring in tax returns from other years, and the things that they put on these things can be crazy, right? So I understand where the IRS is coming from in that there is a lot of people who just don't do a good job, whether it's intentional or not, to be determined. But people don't do a good job of treating their business like a business. And so they end up with this hobby-esque kind of approach to things. The IRS also publishes another report. There's a statistics of income division in the IRS, the SOI, and they publish data on all kinds of tax return statistics. They're like 10 years behind on corporates, but on personals, they're only about 3 years behind. So 26 million, this is as of 2022, 26 million returns were filed with a Schedule C, and that had $1.2 trillion worth of income. Meanwhile, 9.7 million returns had S corporation or partnership income on about $1.0 trillion of income. So now I'm sure some of those overlapped, but there was 3 times more Schedule C businesses out there producing roughly the same income. And that means millions of people are in the wrong structure. Okay. So if we do a little bit of math here, those Schedule C filers paid $81 billion in self-employment tax. If even half of those switched to another structure like an S corporation and had S corporation profits instead of self-employment earnings, that's $40 billion in that 1 year in unnecessary taxes. $40 billion. Now, my mission is to save Americans $1 trillion in taxes, and I'm willing to take that over a few years. 40 billion a year is a good chunk of that $1 trillion already. This is not a trivial change, and this can be oftentimes, when we look at tax returns, the self-employment tax is greater than the actual income tax, but it all gets added together when you file your 1040. Let's talk for a second about what an S corporation is. You've probably heard about S corporations. So an S corporation is a small corporation. It's under subchapter S, which is why it's called an S corporation. And basically, it's got 100 or fewer owners. It has all more or less individual owners. There's only one class of stock. So Facebook, for example, has multiple classes of stock, and Zuckerberg owns the majority of the voting stock because they play these games with different classes. In S corps, you can't do that. If you pay out a profit distribution, it's got to be equal to everybody per their percentage ownership. You can't favor one owner versus another. You can do that in a partnership, but not in an S corp. Now, the major benefit of an S corp is that the profit comes through to the owners and the owners pay the tax on it, but they do not pay self-employment tax, and that income is eligible for qualified business income deductions, which we'll get to later. It can be a huge way to save yourself some taxes on the self-employment side. Now, there is a caveat to that, and the caveat is what's called the reasonable compensation requirement, where the S corp on money you're taking out of the S corp, the first money has to go towards your reasonable comp, and only after that can you start taking profits. And what's reasonable? Not defined anywhere. So there is a method of determining what is reasonable for you. And basically that comes down to tracking what it is you actually do. So all solopreneurs, maybe all not being an exaggeration, but it's going to be all, are chief cook and bottle washer, right? So not only are they providing the service that they're doing, so let's say you're a consultant, you're consulting with your clients, but also you are doing email marketing and you're doing invoicing and you're maybe chasing down somebody whose credit card didn't work. All these other things are time spent in job functions that are different than just providing the service that you're selling, okay? And so what you do is you track your time and you figure out in your market for your type of business, what would that job pay per hour for that job function? And then you figure out all the different job functions you're actually doing on a full-time work week. And then you figure out the weighted average rate that you should be paying yourself. And that's going to be your reasonable compensation. And then over and above that, you're going to have net profit. So think about it this way. The reasonable compensation is if you were to replace yourself by hiring out, and then the profit is the economic activity that is produced by the business itself. Okay, so those are two separate buckets. So the profit that is created by the business itself is going to be not only preferentially non-taxed for self-employment, which is a 15% difference, it's also eligible for up to a 20% discount through the qualified business income deduction. Okay. So qualified business income, or QBI, was created in 2017 with Trump's first tax reform, the Tax Cuts and Jobs Act. And so what it did is it created this new category of income for all types of pass-throughs. Schedule Cs do apply for this because of the self-employment tax usually becomes a wash. So basically you can get up to 20% of your profit as a deduction. You can get up to 50% of the wages paid as a deduction, or you can get up to 2.5% of the assets owned as a deduction. And which one of those is the limiting factor is going to depend on a couple different things, including your filing status, how much total income you have from all sources, and then what those different components actually are. The upshot of all of this is that, yes, S corporations are a little bit more complicated. There is a bit more to do. You have to file a separate tax return, and that in and of itself, that shifts your category from that individual tax return into business taxes, and that creates a much lower audit profile just by itself, on top of the actual tax savings. So the question becomes, when does switching to an S-Corp make save you money? When does it make sense? And if you ask 10 different accountants, you'll have 10 wildly different answers. I've heard some people say, oh, you got to be making $200,000 before it makes sense to switch. That's nonsense. Fundamentally, when you have net profit that is over above what your reasonable compensation might be, then it's going to make sense to start looking at switching. And maybe you don't do it the first year, maybe you do it in the second year. Who knows, right? Everything is going to depend on your facts and circumstances. So you're going to have to look at salary versus distributions. You got to look at having cleaner books. You got to look at having less audit risk. You got to look at potentially at preferential retirement strategies, because you can do a 401k, whereas in Schedule C, you likely can't. You're going to look at reducing your self-employment tax. You're going to look at being an operational professional, running your business like a real business. A lot of people will say, oh, I'm not ready. I'll do that next year. I'll be more organized. None of it makes any sense. So the fact of the matter is that when is now a good time? So not that you have to make the change, but you want to start thinking about things and start investigating what is going to make the most sense for your particular situation. By having the structure, I've seen this a million times, by having the structure, that creates the readiness, and that almost gives you a sort of permission to be a more professional business person. And every year that you wait, you're tipping the IRS for free, which pains me in my soul, actually. So the wrong structure is the first leak in the boat. The next leak is paying yourself the wrong way. What happens when you mix personal and business? This is one of the big no-nos, which hopefully you already know. There's going to be chaos. There's lost deductions. It is harder to defend against audits. You don't have any clarity on the way your business is going because you don't have a real financial picture. And then there's the stress and the shame and everything that goes along with knowing that your situation is a mess and not taking action to fix it. On top of that, most people, when they operate their business, there's the revenue comes in, they have their expenses, and then they say, oh, here's what's left. So that's the profit last. That's a scarcity mindset. What you want to do is put the profit first. In fact, I'm actually Profit First Professional, which was Profit First was a book written by Mike Michalowicz. And essentially, the point of the whole system is to put profit first. What we focused on first is going to expand to occupy our attention. So, it's going to train you by putting profit first. It's going to train you to treat your business like a business. Okay. So revenue comes in, profit comes out, and then whatever's remainder you have to spend on expenses. So not only does that help you organize things, it makes filing taxes easier. It makes all your records cleaner and more available for insight. And that creates predictable cash flow. So you're not operating in what we call entrepreneurial poverty. So many small business, and I've been there myself, so I'm not criticizing, I'm just describing that so many small business owners operate in that, oh, if I just do this one more thing, that will unlock everything and then life will be fine. The reality is you have to plan in the correct kind of way so that your business will run properly and be able to pay you, because the business's job, yes, you're going to serve your clients, whatever that might be, but the business's job is fundamentally to support the lifestyle of the owner. Okay, that's true of stock you buy on the New York Stock Exchange, and that's true of the stock that you have in your own company. Okay, so there's a very simple system that you can implement. So you have a business account, and if you don't already, please have a separate business account. You're going to have money come in there, and then you're going to distribute it to different accounts. And you're going to have an account for profit. You're going to have an account for your own compensation. You're going to have an account for tax savings. You're going to have an account for spending. You're going to have an spending on systems. You're going to have an account for spending on people. And then depending on what type of business, you might have another account for cost of goods, cost of service, if you're outsourcing, that kind of stuff. And you create very clear, easy, predictable transfers from that incoming account to all the other ones. And then once you pay yourself correctly, you feel like a CEO, you feel like a business owner rather than a freelancer or a contractor. That's mistake number 2, is not paying yourself properly. And to top it off, if you do that properly with the correct planning, like we talked about before, that's going to optimize your qualified business income deductions. There was a guy I talked to this past week. I met him at a conference and we went over his numbers. By changing this one thing with how he paid himself, saving him $60,000 a year. That's every year. All right. That's the great thing about tax savings, is that if you implement the plan, they compound year after year. So mistake number 3, reactive tax planning. So most people put their blinders on, go through the year, they get to February, March, April, October sometimes, and they say, oh crap, I got to do all this stuff. I got to get all my papers together. I got to get into the accountant. And then they say, how can I save on taxes? The way to save on taxes is to talk to a tax professional 6 months ago. So the tax return that you file is the last thing that happens in the process. That's you submitting the reports to the government saying, here's what happened this year. All throughout the actual year, that is the time to do planning. That is the time to figure out, how much am I making? How much am I spending? How can I recharacterize things? How can I implement tax strategies to save myself on the end of things? The tax planning happens during the year. And then after the end of the year into the beginning of the next year, that's when you do all the filing parts. But again, the filing is not where you save money. The planning ahead of time is where you save money. So, if you wait until the end, you have basically no time to fix mistakes. You have no time to strategize, and you're going to end up with whatever number that you end up with. If you're planning now in November or October, or with our best clients, we talk all throughout the year, you have time to execute changes. You have time to look at, okay, here's how business is going this year. Here's our projections. Here's what we need to do in order to mitigate whatever situation it is. Maybe it's too high, maybe it's too low, who knows? And it allows you time to capture every legitimate deduction you're entitled to. So that's the proactive way to reduce liability. So proactive planning is equal to printing savings. Okay. So whether it's shifting income or adjusting the payroll or investing in equipment or planning expenses or retirement moves or timing strategies, there's a whole litany of different strategies and different techniques to implement. But the point is, you got to do it during the year rather than waiting till the end like most people. So mistake number 4 is doing the wrong bookkeeping. Nobody wants to do a spreadsheet except me. I love spreadsheets. That's why I'm a tax accountant. Instead of having like a spreadsheet jungle of all these different things, get a Cockpit, and the professionals that you work with should be able to provide you with the key numbers in your business. So what I did was I ended up creating the ClearPath accounting system, and that's for businesses making basically less than $1 million. Once you're over $1 million, it's time to hire a fractional CFO. But if you're under $1 million, then you're not going to be able to afford $5,000 a month or whatever the cost is. I've seen all different kinds of quotes. And basically, what the ClearPath system does is you categorize your money in 5 different ways. So there's revenue, there is cost of goods or cost of services, there's customer acquisition costs, that's your advertising or whatever it is you do in order to bring new customers in the door. There's operations people, and then there's operations systems. Okay. And everything beyond that is what we call SDE, seller discretionary earnings. Depending on how much money you're making after your cost of goods or cost of services, that's your real revenue. So let's say I am selling these things and they cost me $2 to make and I sell them for $4. If I sell one, did I make $4 or did I make $2? The real answer is I made 2. Okay, so that's why when we look at the real revenue of a business, we're talking after cost of goods or after cost of services, if you have a contract out kind of scenario. And so you start there, and then depending on what bracket that number is in, rough ideas as we go, 0 to 250 is bracket 1, 250 to 500K is bracket 2, 500 to $1 million is bracket 3. And then there are brackets over $1 million, but like I said, once you're over $1 million of real revenue, it's probably time to hire somebody who can pay a lot more attention to your business. And so from there, we have percentage allocations of how much should I be paying for marketing and bringing new customers in? How much should I be paying for operational people? And how much should I be paying for operational systems? I was just working on a client's books earlier, and they're in the tile and countertop kind of business. And we did that analysis and we found, okay, you're underspending in customer acquisitions because they were only spending about 8% and they should have been spending about 15%. So they're doing less marketing than they could. So there's room there to improve the revenue by advertising for more clients. They are overspending on people and they are overspending on systems. And it turned out a lot of that system cost was interest expense. So that interest was eating up the margin in the business. And the people was high, but sometimes that's worth doing depending on your situation. So by having that kind of analysis in that financial cockpit, then you can start to ask intelligent questions of your own business. Because like I talked about earlier, there are so many small business people who never have any business training whatsoever. I'm a great plumber, so I went out and became a plumber under my own business, and people hire me, and I do great plumbing. Fantastic. How's your plumbing business? I don't know. I had a guy who gave me we were doing his taxes, he's a painter, and he gave me a handwritten sheet. And at the top, it said revenue or income or something. And then it listed all of his subs. And then he had a line for the paint supplies that he bought. And it came out to negative $70,000. And I called him back and I said, I think you double counted something because the supplies and the contractor expense was about the same. I was like, did you pay for the supplies separately or was that included in the amount that you paid to your subs? Because given the thing that you gave me, you lost $70,000 this year. Did you kick in 70 grand to your business? Oh, no, I didn't do that. It's like, okay, so we're missing something here. And it's because there's no clarity in the records, right? There's no clarity in the bookkeeping. And so I hear people all the time say, I just do it. I just hold on to my bank statements. And then at the end of the year, I total everything up and that's fine. And fine would be an exaggeration, but it is doable. But what you're missing out on is the opportunities throughout the year to figure out what is going on in your business rather than just opening up your bank account and say, oh, there's money in there or, oh, there's not. Those messy books end up resulting in missed deductions and end up costing you more money in taxes. And as the IRS does not accept, I forgot. So that disorganization really results in money left on the table. When you have clean books or a clean financial cockpit, what that means is everything's categorized correctly, everything is reconciled, you have a clear audit trail in case something happens. If you're in the construction industries, they audit for workman's comp all the time. And you have numbers you can actually trust to make the next decision in your business. So many people view bookkeeping as a cost. It's either I have to spend the time doing it or I have to pay somebody to do it. And that's just going to cost me time and or money. If you use your books correctly, they are not a cost at all. They are an investment in making your business better. Because when you actually review your books and know what to look for, which is another part, when you know what to look for, you can then see the story of what's happening in your business in real time. And you can see what's happening month over month, quarter over quarter, year over year. And you can understand the trends of what's going on. Because fundamentally, the reason to do this is so that you can make better decisions and double down on what is working and reduce what is not working. But if you don't have the information, you can't make decisions. And that's where most people are. Do your books in a way that is actually useful and create those guidelines for yourself and your business so that you can make better decisions into the future. All right, mistake number 5 is missing deductions only entrepreneurs get. So there's a whole bunch of stuff that used to be a thing. So in 2017, the world changed. We have the Tax Cuts and Jobs Act, and we have a radical shift in the differentiation between entrepreneurs and employees. Okay, so there was always a difference, but it was made more extreme by the Tax Cuts and Jobs Act. And now that we have the One Big Beautiful Bill, it's permanent, at least until Congress passes a new law, which won't be anytime soon. It's usually about once a decade we get a tax reform bill. So simple stuff, home office, vehicle usage, equipment, travel, continuing education, all this kind of stuff, not available at all to employees, is available to entrepreneurs. Okay, and the reason, again, Congress passes laws in order to incentivize people to increase economic activity. Employees don't do that. Employees effectively do what they're told. Entrepreneurs create new value. That's the fundamental difference. And yes, I'm not bagging on employees. Obviously, whatever you do is valuable to your employer. But in terms of creating the new thing that then produces an economic surplus in the market, that's the job of the entrepreneur. That's the job of the business owner. I had all kinds of people during COVID say, I'm working from home now because we all went remote. And a lot of people are still remote. And I got to tell them, hey, I'm sorry, that's not a thing anymore. So before 2017, yeah, you could include your home office, even if you're an employee. It was subject to a 2% cap or a 2% floor on AGI, but they were still in there. And we had lots of clients who were like traveling salespeople or recruiters, and this hit athletes in a huge way because they would pay 10% to their managers and business people and all kinds of stuff. And all of that just went away. Okay. But it is still available in the business world. All right. So if you are, if you have those kinds of things, then you want to think about, am I capturing those? Am I treating those in the right way? Am I categorizing things correctly? Am I saving the money Congress says I should save? Okay. There's also other things to be done, and there's going to be startup costs. There's going to be potentially family payroll strategies. There's all kinds of things that can be done. In fact, I was just talking to some friends of mine who are starting a new business and are making a new type of dessert. And they created their company, but they're still spending money out of their personal accounts. And I said, hey, make sure you keep that under $5,000 because that's the limit for startup costs. Once you are in operation, then you can deduct costs from the business beforehand, the business from there on. But before all that, you're limited to $5,000 of startup expense. Beyond that, you have to capitalize, which means you take it over time. There's a lot of details to be followed in all of these things. If you are using your vehicle for your own business and for your personal life, you got to distinguish between the two. You got to keep logs. You got to be able to demonstrate if anybody were to ask, it's okay, this was a business trip because XYZ, and this was a personal trip because ABC, right? And by documenting all these things and capturing them, then you're able to reduce your taxable income and keep yourself safe from an audit perspective. All right. Now, there's a million different versions of that, and I won't bore you with going into exhaustive detail there, but just take my word for it that capturing deductions is vastly underutilized. I go into businesses and talk to the owners and figure out their financials, and we're missing out on $20,000 worth of extra expenses. And that can move the needle significantly when it comes to your final tax picture. All right, mistake number 6, retirement vehicles. So if you're a Schedule C solopreneur, pretty much, this is not a hard rule, but pretty much the thing to do is an SEP IRA, so a simplified employee pension. And basically what that amounts to is 25% of your net profit. Okay. So that's okay as far as it goes, but it is inefficient from a tax perspective. Why? And it's because the Schedule C has to file its net income. It's the self-employment tax is going to be assessed on the net income, and then the deduction for the SEP contribution is limited by the total, 25%, and is limited because it does not affect the self-employment tax. On the other hand, let's say you're in an S-Corp. Okay, now you're paying yourself as an employee and you have the business entity as an employer. Here you can set up a solo 401k. Now, a solo 401k is more efficient because the employer contribution is limited to that same 25% of the wage, but the employee can also kick in 23 grand. Now, the numbers change a little bit every year. Right now it's 23,500, but the point is that you can contribute in 2 different ways, and that allows you to contribute more on the same amount of money. And that 25% employer contribution is going to reduce the net profit from the S corporation, and the 23,000 up to the employee contribution is going to reduce the amount that hits you for income tax. Okay, so you're still paying payroll tax on the full wage, but the income tax portion is reduced by whatever you contribute to the 401k. So this can be a pretty powerful, not only retirement saving strategy, but also pretty powerful tax saving strategy at the same time. And depending on what you want to do, maybe you do traditional, maybe you do Roth, but there are options there, and it depends on what your assumptions about the future are as far as which way is most optimal there. But optimizing the salary in terms of amount for the QBI deduction and building in the retirement 401k contributions, that double effect can be super, super powerful for your business and your overall tax position. All right, mistake number 7, no audit proofing mindset. Okay, so the biggest fear people have is audit. Okay, and there's a good reason for it. So even if you're 100% right in whatever tax position you've taken, the process is the punishment. Okay, so what we want to do is, 1, do things in a way that's going to reduce the chance of audit in the first place, like getting things off of your Schedule C and into an S-Corp. But also, if it does happen, you want to have everything ready to go so that you are in the strongest position possible for responses. So when it comes to letters that the IRS sends out, 70% of them never get any response at all. And I was one of them. So when I started getting those letters that I owed $1 million, I didn't respond. I just stuck my head in the sand. But if you do things in the right way, then you have the documentation ready to go. So here's an example. I've got actually two different examples, one on either side. So back in 2014, something like that, this was back when we were able to take those employee expenses for reimbursed employee expenses. So this was a married couple. They were both recruiters. They were to recruit doctors for hospitals. Made a lot of money, but they'd travel on their own dime for all around the country, visiting different doctors and getting them on their lists and say, this hospital over here needs an orthopedic surgeon. Let me call my orthopedic surgeon guys. And they've built those relationships over time. So they had a lot of expenses that they wrote off on their taxes. And one of the years they got audited. They got a letter from the IRS. And let's understand what an audit means. It means getting a letter, right? And it means responding to that letter, hopefully. And so they got a letter from the IRS, and they were questioning the unreimbursed employee expenses. They said, okay, you got to prove to us that you had all these expenses. That's pretty straightforward. And then you also have to prove to us that this was required by your job, because that's part of at the time, that was part of the requirements. And they come into the office, we go over what everything was in the letter, and then we give them plans. So, okay, here's the 5 things you need. Go back to your employer and get all this stuff, bring it back, we'll put it together and send it back. So they did that. They each came back with a 3 or 4 inch binder full of documentation, not only their own records and highlighting where everything in the accounting business, we call this tick and tie. So everything would get a tick and it would tie into the overall numbers. They highlighted all their bank records, credit card receipts, and so on. And then they had all their policy documents from their employer. And it was all tabulated and color coded and everything. And I took one look at this and I said, you're never going to hear from this guy again. So we boxed it all up, mailed it off, and 2 months later, they get a letter, no changes, done. Right? Now, another client of mine was playing the short-term rental game. Now, the short-term rental game is special because if you have an average stay that's under 7 days, then you are not in the rental business, you're in the hospitality business. So there's different rules as far as what can be deducted and what can't, depending on other income. And they were following all the rules, and they got a letter. And the letter said, prove this, prove that, prove the other thing. And so we were talking, the client and I, and he said, I think I'm just going to pay it. And I said, what? And it was a sizable chunk of change. It was 5 figures. And he said, yeah, I mean, I could do all this. According to you, talking to me, it's going to take forever and it's going to be a whole lot of back and forth and all this kind of stuff. I said, yeah, that's true. The process is the punishment. So yeah, I'm just going to pay it and I'm just going to make more money. And for him, it turned out to be the right decision. So he paid the fine, essentially, and then he turned around and spent that time that he would have spent fighting with the IRS back and forth over this money amount and launched his new business and made a new $1 million. So in his scenario, he was absolutely correct that the expense of the attention was more than the expense of what he could make on his own. It would be better, though, to have both, right? So you have everything ready to go, all your documentation in a row. So you just send out that response that terrifies them into submission, and you can then go off and generate your new business, right? Easy record keeping is the best way. And like with the bookkeeping, people put it off and say, oh, I'll get to that someday. So if you just keep your receipts, take pictures of them if they're cash receipts. Most things are email now, so that's pretty easy to keep. Keep clean books. Keep your records saved for 7 years. I'll talk about why 7 years in a second here. Do your mileage tracking. There's apps for this, so that's pretty easy these days. Keep money separated, business accounts, personal accounts. Keep all your payroll documentation. Basically, just keep the stuff that they might ask about. Have the stuff in the first place by being organized and planning your stuff correctly, and then just keep it for 7 years. Now, why 7? If you look at the IRS or the statutes, the IRS can go back up to 10 years on taxes. That's the statute of limitations. So as a professional tax preparer, I'm required to keep records for 10 years. Now, by policy, the IRS only goes by 6. So that's just an internal policy that they have. So that 6-year window is where the 7 years comes from. So you have the 6 years plus or minus where we are in the current calendar year. So that leaves 7. years that you keep things. By reality, they typically only go back 2 to 3 years. Now, they can expand if they go back 2 years and find something, and we can find more money for the government. But typically, they're only going to be looking at the most recent 2 to 3 years. So if you keep your stuff for 7 years, you're pretty much good. If you want to be a little bit more paranoid, keep it 10 years. If you want to be like somebody I know, they have tax returns going back to 1978, longer than I've been alive, actually. But it depends on your comfort level. But at least 7 is the thing to do. Because if you can't rebut, if you can't come back to the IRS, if they ever ask a question, then they win. That's fundamentally where it comes down to. So what the IRS really looks for is documentation. That's where they get everybody. People keep bad records, and so they can't substantiate whatever they claimed, even if they spent the money, even if they spent it for a business purpose. They can't tie it down to, I was with Joe, and we talked about this, and therefore this is a business deduction. And so that's the vast majority of what the IRS gets people on. Very rarely will I get people on true just making stuff up. I have seen some people make stuff up, and I tell them not to do it, but it's rare. Mostly it's how much did you spend on this thing? I think it was like $300. Can you prove it in any kind of way? No. But so that's really the core problem. If you keep your documentation, and today it's easier than it has ever been, just keep pictures of things, throw it in a folder on your hard drive, or not even on your hard drive, on some kind of backup device that is synchronized, hopefully across a couple of different devices in case you have a failure. And then if and when somebody asks for something, it's ready to go. All right, tax freedom framework, right? I've developed over the years what I call the ultimate tax plan. And the ultimate tax plan is mapping all these different things, putting the kids on payroll where appropriate, having the business entities in the right way. If you go into business with your buddy, where should that be? What kind of entity should that occupy? And how does that flow into your personal tax life? What do I do with stock? What do I do with rental real estate? All these things are covered in the ultimate tax plan. And that's what I've developed over the last 15 years and 50,000 tax returns that I've worked on. What is the framework that I can put into place and figure out? Obviously, not every element is going to apply to every person, but figure out what elements apply to me and how can I organize my tax world in the most effective way. So that's part 1. Part 2 is having your financial cockpit and doing your numbers in the way that allows you to make better decisions in the future, improve your business, make more money, and eventually maybe pay more taxes because you're making more money. And number 3 is proactive tax planning. It's not a one-time kind of thing. It's not a after the end of the year. It is a during the year, especially as we come closer to the end of the year like we are now. So if you do those 3 things, set things up correctly with the ultimate tax plan, look at your numbers monthly, and proactively plan throughout the year, you're going to be in the best position possible. So if you want more content like this, go to my YouTube channel. That's where I'm publishing everything I'm doing on TikTok or LinkedIn or Instagram or Facebook. It's all going to live on YouTube long term. It's not about becoming an accountant. I do what I do because I love it and I'm good at it. You do what you do because hopefully you love it, but also because you're good at it. You just have to know enough to be able to do things correctly. I don't have to be a professional race car driver, but I do have to be able to drive from my house to my office. Okay, same kind of thing here. You don't have to be a professional accountant. You don't have to be a professional tax preparer or tax planner, but you do have to know enough to talk to the right people and ask the right questions so that you can be in the best position possible. All right, that's it for now. I'll see you guys next time.